Is there an income limit that you've got to be aware of in order to fund a Roth IRA? Meaning, in order to contribute money into a Roth, your income can't be too much. Yes, there is, and it surprises a lot of people. I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so I had this circumstance a couple times over the past couple of weeks, and then again, I shout out to Brittany from the Bay Area. She called in. She's a fan of the Wise Money Show. It's a similar sort of issue, and I thought, okay, I got to talk about this. And that is, you know the benefits of the Roth IRA, and at one point in your life, you say, my goodness, yes, I would love to contribute money into an account, and I don't need the tax benefit today because I'm worried about the tax benefit in the future. And so I'll contribute to the Roth IRA, invest it, all that money will grow tax sheltered. And then in the future, when I'm retired, I'll draw all that out tax-free. Wonderful deal. Sign me up. And you start funding, whether you're contributing the maximum amount, $6,000, if you're younger than age 50, or $7,000 if you're older, or you do that once a year or multiple times a year, you do it monthly, $500 a month, whatever. You set that in motion. And you sort of have this goal, I'm going to fund that Roth IRA every single year. Well, when you maybe start funding it, your household income is maybe 120 grand, and then it grows to 150 and 160, 175, 180, 190, and then all of a sudden you're making around 200,000 or something like that. You're still doing this, and then you talk to a professional, or you see an article, or you see a video, and someone says, well, you can't make too much and still contribute to a Roth IRA. There's an income limit, and this wave of panic kind of washes over to you. Like, wait, do I make too much? I know way back then maybe I didn't, but do I make too much now? Yes, there is an income limit in order to contribute to a Roth IRA. Okay, same with an IRA. We're going to focus on the Roth right now, and that is two things. Okay, it's both sides. You can make too little in order to fund a Roth, and you can make too much in order to fund a Roth. The contribution limit is you can contribute up to 100% of your earned income. So your wages, not portfolio income, something like that, your wages up to a $6,000 limit if you're younger than age 60, or $7,000 if you're 50 or over. So you've got to have earned income, not just dividends or whatever. You've got to have earnings in order to contribute to a Roth IRA, okay? So that's one limit in order to be able to contribute. So if you only make $3 grand, or you've got a child that's making $1,000 or something like that, their contribution limit is $1,000. Even though the normal contribution limit is $6,000, their limit's only $1,000. It's up to the amount that they made. For the rest of us, if you make 30 grand, you make 50 grand, whatever, then obviously the $6,000 limit is the maximum there. But on the other side of the income spectrum, can you make too much money where you are no longer allowed to contribute to a Roth IRA? Yes, you can. And this isn't an earned income limit, it's an adjusted gross income limit. So yeah, your earnings apply, but dividends apply, capital gains apply, rental income applies, unemployment income, all of that gets added up to calculate your adjusted gross income, and that determines whether you're able to contribute to the Roth IRA or not. Check out this schedule right here for those income limits, okay? For married filing jointly, if your adjusted gross income is below $198,000, you can contribute. That's fantastic. But if your adjusted gross income is between $198,000 and $208,000, then you're limited. You're phased out. It starts your contribution starts to go down, and then when your adjusted gross income is over $208,000, you can't contribute to a Roth anymore at all. For single or head of household, that limit's $125,000, that adjusted gross income. If you're married but file separately, and we have some clients that do that for whatever the reason, $10,000 is the adjusted gross income limit. You almost have to say, if you're married filing separately, you make too much. You can't fund the Roth IRA. So now let's go back to this scenario where maybe you are making between, you're married, and between both of you, you're making 175 grand. You say, I want to do this Roth thing. So you start contributing to the Roth, and then income goes up, and probably 5-6 years down the road, all of a sudden you find out your income's been above this limit, and you've still been funding the Roth IRA. Is there ever a mechanism like there is with the 401k or something like that where they all of a sudden just automatically stop you? No. No, you've got to be self-policing this. Otherwise, the IRS could, and I'm just going to tell you, they have a terrible mechanism for finding this out. So it's almost like, well, you might get caught, you might not, but obviously you want to do things where you don't have skeletons in your closet or worries where the IRS is going to come after you. But there's not this automatic where just by default, they're going to know, the system will know you shouldn't have funded a Roth, therefore you got to take some action. No, you could be doing this without knowing. You could be funding a Roth when you're not allowed to for years. So the first thing you need to do is you need to fix it. You need to fix it. There's a 6% penalty on the excess contribution if it stays in there. And what if you say, well, I made an excess contribution years ago, okay? That 6% penalty is there each and every year until you withdraw that excess contribution. So I'm going to do a video coming up about how to fix those excess contributions, but for those of you that want to get creative, number one, you got to fix it, okay? And obviously stop, make the correction so that you're no longer contributing if you make too much money. Second then is, well, what if you make too much, but you really like the benefits of the Roth? You can't contribute directly to the Roth IRA. What are your options? And that's really the crux of the video. Number one, your first option, if you can't contribute directly to the Roth IRA, can you contribute to a Roth 401k? A Roth 401k is your normal 401k. Your normal 401k has a pre-tax door and has a Roth door. It's required to, okay? Your 401k has a pre-tax door and a Roth door. If you have a 401k available, you've got both doors, and you've just got to figure out, well, which one should you be contributing through? And if you like the benefits of the Roth and you are unable to contribute to a Roth IRA, I would look at contributing to that Roth 401k, all right? So that's the first choice, if you make too much money. The second choice, if you make too much money and you can't contribute directly to an IRA or to a Roth IRA, look at the backdoor Roth IRA. Now, this does not apply to everyone. Done several videos about this in the past. The stars really need to align. If you don't have any other pre-tax IRA money, then you can contribute after-tax money to an IRA and then convert it into the Roth. Works fantastic. They call that the backdoor Roth. And you might say, well, wait a second. If I make too much money to contribute to a Roth, how can I contribute to an IRA? Well, that would mean you make too much money to contribute in a deductible way, most likely to an IRA, but you just don't need to deduct your contribution to the IRA. You can deduct it, or you can contribute but not deduct it, and then convert it to the Roth IRA. That's called the backdoor Roth. I'm not going deep dive there. I've done several other videos, but if that might apply to you, talk to your certified financial planner. See if the stars align in your situation as something you should consider. Third option, if maybe you're maxing out the Roth 401k, you've done the backdoor Roth, or one of those don't apply, and you say, how can I get more dollars growing tax-free for my future? I'm not as worried about my taxes today. I want to defer and I want to avoid taxes in the future. Then the third option is the HSA. Now, you need to have a qualifying high deductible health plan in order to contribute to the HSA. But the HSA, again, people look at this, have conventionally looked at this as a savings vehicle for upcoming medical expenses, typically known upcoming, meaning what am I going to spend in the next 12 months on medical expenses? Okay, that's what I put in my HSA. No, guys. The laws, the tax laws, the tax benefits with the HSA is you contribute money pre-tax. It gives you a tax benefit today. And then when you withdraw the money for qualifying medical expenses, you draw it out tax-free. It's the only thing in the tax code where it's pre-tax in, no tax out. But you get to invest your HSA. You can choose to invest it, and you can choose to pay your medical expenses just out of pocket and then reimburse yourself from the HSA later. This shoeboxing or investing HSA idea, I would put right along the same lines as funding that Roth IRA. And if you're not allowed to, is there an income limit for contributing to an HSA? No, there is not. So as long as you have a qualifying high deductible health plan, I would consider investing the maximum amount into your HSA, actually investing it and letting it grow tax deferred and tax free for your future, and then shoeboxing or paying your out-of-pocket medical expenses out of pocket, and then saving receipts for a future withdrawal. Is there an income limit where you make too much and you can't contribute to a Roth IRA? Yes, there is. It comes up, it catches people by surprise a lot if your income is growing over time. Or let's say your income is close to that threshold but not above, and then all of a sudden you receive an inheritance, or there's a big capital gain, or you sold a house or something like that, and all of a sudden for that 1 year your income goes above that limit and then it comes back down. Yeah, you can't fund the Roth for those years, okay? Number one, you've got to fix it, okay? Upcoming video about that, how to fix those excess contributions. Two, what are your options to contribute to accounts that grow tax-free for your future Roth 401k, backdoor Roth, maybe HSA. But the third takeaway is be careful. Be careful of implementing advice that you hear online or read an article about. That's why every video that I do on the Wise Money Show is going to end with work with your certified financial planner, because these great concepts are all circumstantial. They all depend on whether it's a good idea or a wise idea, depends on how it applies to your 6 areas of your financial life. There's a bunch of good ideas. Why do we need wisdom? Wisdom is knowing the best of several good choices, the best choice to make. That's when you need wisdom, okay? Otherwise, it's just smart. It's a good idea. Oh, consider this. Okay, good idea. What's the best idea? Well, I've got multiple choices. What would wisdom do? That's the Wise Money Show. So guys, sit down with your certified financial planner. Talk about these options. Maybe you're not even close to the income limit, and you just got to work with your CFP to see, should you do pre-tax, should you do Roth, something like that. But if you are at or above that income limit for the Roth IRA, explore your other options, see what the best choice is for you to do. As always, work with your CFP on applying that information. If you don't have a CFP on your team, we can't help everyone, but you can always contact a CFP on my team. Find us online, korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.